Okay, so today we are ready to start talking about Chapter 1. So the plan is to kind of talk about Chapter 1, and then as we get to certain concepts, we'll actually go into the Chapter 1 practice and do some examples together. First chapter, there's just a lot of background, learning about accounting, so we may not get through very much practice today, but whatever we don't get through, we'll talk more on Chapter 1 on Wednesday. So the plan is to cover Chapter 1 today and Wednesday. So basically, again, the first chapter is really an introduction to accounting, what the purpose of accounting is, and then our basic accounting equation. So the first part of the chapter is really just learning a little bit about why we need accounting. So again, we'll kind of hit the highlights of some of this. Most of you did the little adaptive learning plan, so you already kind of answered questions on a lot of this, and obviously the biggest point of a business is to earn money, right? That's the end goal, unless we're nonprofit. But we're going to focus in this class on publicly traded corporations. So we're looking at companies that their main goal is to make money, which is a profit. So obviously the profit is just how much money is left after we sell goods, all of our expenses are paid. So we're just going to learn how to account for that, because obviously that's the most important part of the business. So in accounting, we're going to learn how to calculate profit and a lot of other concepts as well. It kind of talks about, the different types of businesses: service, merchandising, and manufacturing. You may have heard these in an intro to business class or another business class as well. We're going to focus the first half of the semester on a service-oriented business. So we're looking at a very simple business structure where we provide a service to our client and they pay us for our services. It could be, they mention like transportation, like Delta Airlines, Walt Disney, entertainment. I think the book we're going to look at like a consulting firm. So they're providing consulting services. A lot of times I like to even make it a little easier and just be like, well, what if I mowed lawns, as a side job? And so anything that we're not selling an actual tangible item, we're just providing a service to the customer. So the accounting for that is going to be pretty straightforward and more easy. So that's why we're going to focus more on that as we learn the accounting cycle. And the second half of the class, we're going to talk about merchandising. So that's companies that buy goods and then resell them, for a profit. So there's just a little bit more that we keep track of. If and when you take financial accounting, we'll also focus on merchandising, and then manufacturing we won't get into in this class since it's an intro class. That'll be in managerial accounting if you take that course. So manufacturing is when they actually have a factory and they're making goods that they're selling, like Ford Motor Company, Dell, that sort of thing. So as you can imagine, the costs associated with that and keeping track of that is much more detailed than keeping track of a service. Same here, you might have heard of the different forms of business. So proprietorship is just one owner, So it's usually private. The good news about it is, you have all the decision making, right? As a sole proprietor, though, you also have all of the risk. So if the company goes bankrupt, they can go after you personally, So you have all the liability of the company. Partnership is really the same as a proprietorship. It's just two or more people. So now they're sharing that risk, but they're still liable. Again, we're going to focus on corporations. So corporations are their own separate legal entity. So that's one important takeaway from a corporation. They're taxed as a corporation. It is a separate legal entity. It's owned by stockholders or shareholders, which we'll talk about as we go through the semester. And it's really good because there's no liability or very small liability. If you own shares of stock in a company and the company goes bankrupt, they can't come take your car or house. Kind of a big deal, right? Whereas a sole proprietor or partnership, they can come after your personal belongings to pay off the debts of the company. With a corporation, the most you'll be out is however much you bought in shares of stock. So your risk is limited to that. So generally, the CEO, president, that sort of thing, they have a higher ownership of stock. So their risk is higher, But if you, as an employee or even just as a shareholder, you may own a few shares, you're not out, they're not going to come after you. So again, this course we're going to focus on publicly traded corporations. And then we have limited liability companies. So a lot of companies will start as a sole proprietor or partnership, and they may actually form like an LLC, sole proprietor or partnership. And again, that just makes the business its own legal entity. So the business pays taxes and the business then covers loss. So if the business piles for bankruptcy, then they can't come after you personally. So you have a little bit more security blanket there. But again, it's good to understand the different forms of business, but we are going to focus on corporations. So accounting, well, what do you think of when you think of accounting?
Money.
Money, yeah, very good.
Paperwork.
Paperwork, yeah, details, right? Anything else?
Headaches.
Sadness.
Loss.
Oh man, y'all are positive thinkers. Those are all true, I guess, to some extent. But how about gains?
Gains.
Profit.
Profit, there we go. Well, people, think about accounting, yes, as tedious paperwork, accountants as being boring, right, and rule followers, and, well, yes, we do fit that bill sometimes. There's so many different avenues of accounting that you don't think about. And honestly, the biggest takeaway with accounting is if you don't have good accounting, your business is not going to survive. So you should think of accounting as survival. Really, people form businesses all the time. And if they don't have some financial experience, they don't know how to keep track of their revenues and expenses and employees and all of that, their chances of making it are very small. You can have a great idea, a great concept, and fail because you don't know how to keep track of your money, okay? So accounting is kind of the backbone of a business. If you don't know accounting, whether you're a sole proprietor or a corporation, it's not going to work, okay? So really what we do is we take information and turn it into useful reports to make decisions. Accounting leads decision making, really, you think about it, everything's based on numbers and data and research. Yeah. So it really does drive a lot of our business. So, of course, there's lots of information that we use, and we're going to learn about that. So we have to have an accounting system, some kind of record system to keep track of all of our money, right? And all of our employees and our taxes and, everything fun that you guys mentioned. But the biggest thing is we have to have an accounting system so we know whether we've made a profit, right? And again, it's going to drive decision making on down the line, which we'll talk about throughout the semester and on into other accounting courses too, okay? I guess they went into the managerial first. So there's different types of accounting. We're going to focus in this class on financial accounting, which we'll talk about here in a minute. The other area of accounting, the two main are financial and managerial, but there's lots of different areas. Managerial accounting is really just about everyday decision making. So a lot of people really enjoy, after you've taken these classes where you are doing more of the paperwork and the tedious, making everything balances, everything's accurate. Managerial accounting is looking at reports and making decisions. So it's not always black and white. It's not always yes and no. There's a lot of gray area. There's different decisions we can make. So a lot of people think accounting is just running reports. It's boring, it's tedious, it's matching. But there's avenues of accounting that really are beyond that. There's estimating, that we do. There's budgeting. There's auditing. There's forensic accounting. There's all sorts of avenues. But managerial is really using data-driven decisions. So we're looking at reports that help us decide, do we open another factory? And do we, stop making a certain product? Do we need to raise or lower the price of our product? Those are all accounting-driven decisions. So that's managerial because managers are ultimately the ones making that decision, but they're relying upon the data and the input from the accountant. Again, in this course, we're going to focus more on financial accounting. So it is the reports and the paperwork and all of that. Okay. So where managerial accounting is focusing and running reports for users within the company.
Oh, okay. Thank you.
So managerial accounting focused on what we call internal users of the business. What do you think internal users of accounting would be? You go back to managerial, right? Who do you think would use managerial accounting? Manager. Good. Yeah, right. It's in the name. Very good. Yeah, managers are going to use internal or management accounting. Mainly managers, right? And your vice president, CEO, people like that. But really, it's internal. So it's all the people within the company. Mainly managers, but also upper level, and even employees to some regard, supervisors. Financial, we're preparing financial statements. So we're giving them balance sheets, income statements, statement of retained earnings, which we'll learn all of those statements. We're providing those to external users. So who do you think is interested in seeing our company's financial statements?
Investors.
Investors, good. Employees, they may be investors too, right? Auditors, good. Who wants to take our money?
IRS.
IRS, government. Yeah, same difference, right? Yeah, the auditors for the IRS, yeah. So, yeah, investors, the government, anyone that may be loaning us money too, like banks,
Yeah.
things like that. Shareholders, which are also investors for different purposes.
Loan sharks.
Yeah, very possible. So the whole purpose in this class is to learn how to prepare those financial statements that we can then show external users that, hey, we're making money, so you can invest in us, we're going to be around for a long time. Or, hey, if you loan us money, we can afford to pay it back. Hey, you should invest in us, give us money, we're going to grow the company. Hey, government, we're not making any money, don't take our money. Right, there's some conflict there. But that's what we do. Okay, so we're going to focus on financial accounting and the general purpose financial statements. Okay, so I won't go through opportunities for accountants too much. I won't get up on my soapbox and preach to you about becoming an accountant too much, right? But there are, I think, people associate accounting with a lot of negative connotations sometimes. But there are some other opportunities in accounting that if you like numbers and you like, sitting and crunching numbers and you like rules and you like things to balance, then you might like doing accounting. But people think, oh, you're going to be in a cubicle, you're not going to be interacting. That's not true. There's still interaction. You still have to report that and be able to explain it in like layman's terms to other people, and so there is more interaction. But also, there's just other opportunities within accounting. You can work for the IRS. You can be the one going and
Collecting the money.
Yeah, exactly. You can go knock them. They love to see those people, right? You can be an auditor, though.
Yeah.
You can do auditing where it can be internal or external auditing, where you go in and just make sure that their systems are correct and, that everything's adding up, that there's no fraud, that sort of thing. Or overspending, exactly. You can get your CPA and open your own firm and handle accounting and make a lot of money. That's always a positive, right? You can make a lot of money.
You got to deal with multiple people's paperwork.
You do. That's the
You
truth.
would choose who you want to work for and just have your own clients. That's what my aunt did.
That's
So,
true. We could do that.
Yeah, you get a lot of autonomy, be your own boss, and make 6 figures.
Yep.
So that's always nice,
you
right?
only have to work 5 months out of the year.
And cruise the rest of the time.
Exactly.
So there's public accounting like that. Or you can work for Fortune 500 companies and do public accounting and make a lot of money. You can work in private accounting. So you could do like budgeting or cost accounting and things like that. There's lots of different things. Or public. As you can see, they kind of list some average annual starting salaries and different things you would need. But yeah, there's a lot of opportunities. Some things that you don't think about, like I kind of mentioned, is like fraud accounting. So these are people that are kind of like the CSI people of accounting. So they actually go into a company where there's fraud has been detected or suspected, and they investigate. And they interview people, and they testify in court. And so, but they're looking at accounting data. They're not like who murdered, so-and-so in the break room or whatever. But they're still,
their dividends.
yeah. but they're still going in and doing different things. You have to have an accounting background, you have to understand what you're looking for, but you're still, getting to do some pretty cool stuff. So don't count out accounting. Get that? Count out accounting. Yeah, that's my lame joke. So those are just some opportunities. Again, this chapter is really just looking at accounting in general in this first half. So we talk about what areas there are, and then we talk about ethics. Well, ethics is a huge part of accounting, right? I mean, ethics hopefully is a big part of business in general. But as an accountant, that's one thing, especially as a CPA, you have to sign a code of ethics and have to say, I'm going to handle this information. It's not just money. People think money, fraud, but information can be handled fraudulently too. What about if someone sells your company's information or your trade secrets, or let people into your accounting systems? There's all levels of fraud that may not be money. Okay, so there's a lot of ethics. Of course, ethics are that vague. They're not black and white, right? Because sometimes it can be legal and unethical. So we're not going to have a whole class on ethics, of course, but just know, as we talk throughout the semester, we'll talk about how ethics impacts, especially when we talk about cash, but, inventory management. It's maybe not cash that's walking out the door, but people are taking inventory. Or again, we're just not handling our systems in an ethical way. So it's just important, we need to be ethical, of course. And then they get into all the unethical practices that we've seen. So a lot of what drives us now for our rules and what governs accounting is based off of scandals, most of them illegal and unethical. A lot of them around the turn of the century. So late 90s, early 2000s. If you've taken other business classes or you were just aware of these things when they happened, like the Enron scandal, WorldCom, Xerox, companies like that had major ethical and illegal fraudulent activity within the company. There weren't a lot of accounting, there wasn't enough accounting oversight to mitigate a lot of this. So we were seeing things happen on the CEO and CFO, the chief financial officer, where they were reporting income that wasn't there to drive stock prices up, but then the money wasn't really there to pay investors.
I remember looking at Xerox when they had that happen, because I was looking at their stock and they got hit hard, but it SEC.
They sure did. Yeah, 10 million fine.
Facebook got hit by the SEC too.
Yes.
I think, yeah, they got a huge one too.
A lot of companies have. The SEC is the Security of Exchange and Commissions, and they are the ones that oversee companies and their monetary behaviors and fraud and everything. So yeah, there were some big fraudulent things. Like Enron, they were the ones that were saying they had a lot more income than they did, which was driving their stock price up. And then if you've ever watched, there's like tons of movies and documentaries and stuff over Enron and WorldCom. They were the two really big ones. People shredding things and, they served jail time, like CEO, CFO, people like that. They were held accountable.
60 billion in stock market loss.
Isn't that crazy?
Wow.
It's insane. Because it did. It resulted in bankruptcy. And then they had no money. There was no actual physical money to pay the people what they owe.
On that one, I know that they had a whole group of, what's it called whenever you have like a joint suing press charges?
Oh, yeah, it's like a, oh my
A lot of
gosh.
the
I know what you're
investors
talking
that
about.
had large stakes ended up suing to try and get their stock market, their investment back.
It's hard to collect, though.
It is, especially when the
yeah.
company's bankrupt.
Right, yes. So yeah, they had criminal convictions in that one and Health South, which I'm not as familiar with, and WorldCom as well. As you can see, there were a lot of problems. So a lot of it was all about just fraudulent reporting, and they were having their employees like carry this through. So most of the time, the culture starts at the top, right?
Mm-hmm.
Your CEO and then your chief financial officer, they're the ones that are setting the precedents and telling other people below them, this is how our company operates. So what the SEC did was they said, okay, we've got to mitigate this. We've got to control this. And so they created laws to help control. Do we still see fraud? Oh yeah, you hear about it every day in the news, right? Small companies, large companies. I don't care if you're 2 people running the company with 3 employees or 500,000 employees, you're going to see fraud. But we try to limit it. Okay.
Kind of like what they call a FASC scheme or something like that.
Right. Yeah. like pyramid scheme, same different, yes, all of that. We try, we do our best, okay? So when we're talking about fraud and ethics, we try to limit our employees' availability to commit fraud, okay? There's like the ethics triangle, you know, they have to basically, you've probably heard of that, you know, there has to be like a desire, you know, like you have, or not a desire, but like a need, right? Like medical bills, or we're talking employees here, not like upper level. But, you know, you have an employee that has a gambling addiction or a lot of medical bills because the spouse is sick or kid are sick, whatever, you know, or maybe they just don't,
Agreed.
you know. Yeah, agreed. And then there's usually some opportunity available too where they have access to the funds and being able to steal or however they're going about their fraudulent activity. And then they have to have like some kind of justification. You know, it's usually like, well, no one respects me around here. They don't pay me enough money, so they owe this to me, right?
And that's it, yeah.
Which, I mean, you know, it happens. So like you said, there's greed and failure of individual character. But it's not just that, especially when we're talking about employees. There can be an employee that has a dire need. It may not just be greed. Those upper management that were having their private jets and their vacations, that was greed, you know? But it's not always that. I guess I was getting ahead of myself. We weren't talking about the fraud triangle. It's okay, right? But we were talking about, yeah, the fraud within the management. So as I was saying before I got off on my other tangent, that resulted in us passing a law, Sarbanes-Oxley Act, or SOX for short. So it established the Public Company Accounting Oversight Board, which you don't have to remember, that's what it's called. Sarbanes-Oxley Act, though, is important. So basically it put more control, more oversight over accounting, you know, in these publicly traded corporations. So it does establish some standards for other companies, like independently owned and everything, but really we're focusing, when we talk about SOX, we're focusing on publicly traded corporations. Because they're the ones that we have the most government control over, okay? Because they file taxes, we have government control. So that went about establishing what we call GAAP, Generally Accepted Accounting Principles. So there's just a lot of standards and principles and assumptions that say, okay, I don't care what size business you are, who, you know, what you do, what your industry is, you have to follow these basic accounting principles. And again, these are good for, you know, really all businesses, but they're required to be followed by publicly traded corporations. So we're going to learn some of our generally accepted accounting principles. And as we go through the semester, we'll learn more and you'll apply them more, okay? So again, a lot of words, a lot of acronyms. I want the big takeaway to be Sarbanes-Oxley Act applies to all publicly traded corporations, and it's more oversight on publicly traded corporations. The Financial Accounting Standards Board is the one that develops these accounting principles. So like tax accounting or anything, they put out new principles, maybe, you know, every so often. I think the last one that was major was like a year ago, as revenue recognition changed a little bit. But you're going to see this, you know, as changes need to be made, as we get into more international business, which we already see a lot of, and as we've become more computerized, these standards have to be changed and adopted to fit our new business practices. But again, the oversight comes from the Securities and Exchange Commission. And then worldwide, they're trying to adopt International Accounting Standards Board, because like here in the US, we may operate here and in several other countries. Well, if we don't have any oversight over those multi-nation companies, how are we knowing that all the practices are correct, right? So they're trying, and they've been trying since I've been teaching accounting, to get everyone on board for these international standards. That has not happened yet. But we in the US, anyone that does business in the US or with the US follows the Financial Accounting Standards Board, okay? But they're trying to get it better. So the thing that guides the generally accepted accounting principles is that the information that we're providing to those external users, to the investors, to the government, is relevant. So we're not just filling them full of numbers that mean nothing. which you probably heard the term like dog and pony show, right? You know, and that's how a lot of numbers were. I've been to financial meetings like that where they're like, look what we're doing, isn't it great? And it means nothing. You know, it's all graphs or charts and inflations, and they're just picking out certain little bits that they think looks good. No, that's not good. So we're providing relevant information. And it's faithfully represented. So in other words, it's accurate. So relevant and accurate. That's what we're looking for in financial statements. So again, I know this first chapter is a little more dry. There's less hands-on and more learning about the theories and principles, but trust me, that changes pretty quickly. But the first half, you know, we're talking about different accounting principles. We have 4 assumptions that we're going to go through. Okay. So the first one is the monetary unit assumption. That really just states that all of our financial accounting records are done in dollars in the US, obviously, but some form of currency. You know, we can't, everything needs to be clear and needs to be listed in dollars. That's all that means. Okay. So we can't, you know, if someone invests a boat into the business, we can't just put a boat. We have to assign it a dollar value. That's all that means. Time period assumption. Okay. So that's just saying we're going to assume that when we do reporting, that it's on a specific amount of time. Financial statements, like annual reports, are going to be over 1 year. And we may do like monthly income reports. So we're just defining, it's not just going to be like, here's our net income. Well, when was that from? Oh, you know. So we're just really being accurate on what period of time we're reporting on. These assumptions are pretty simple, but they help define our other principles. Business entity assumption. This is just where we want to keep the financial records of the business separate from the owners. So in a corporation, this really shouldn't matter, but this really deals more with like a sole proprietor. If you own, like I said, if I'm mowing lawns, you know, all my money for my business and my personal, it's all my money. But I still need to keep records for my business separately. Because when I'm doing my taxes and I'm trying to figure out how much profit I made, well, if I'm going to Walmart and buying, you know, lawnmower tape or whatever you call it. I don't mow lawns. I know, I'm like, what's that? You know, what?
The weed eater. You're thinking
I'm thinking of the weed eater. The lawnmower, you're buying a part from the lawnmower. Yeah. Yeah, I don't know. My child and my husband do the mowing.
You would need a blade.
Thank you. A blade for my lawnmower. Yeah. So I'm not always good with the examples, but I'm going to Walmart, I'm buying supplies for my business. I'm buying, you know, a register to keep track of payments too, because I can do that at Walmart. And then I'm buying milk and groceries for my house. I can't put all that on my business. I need to keep it separate. Okay. So my business expenses should be kept separately. My business profits should be kept separately. So, you know, I should have a different account set up and keep track of all of that separately. Because how else are you going to know how much you've made, how much you owe, you know, all of that. So of course, some expenses are shared. And if I'm using a computer for personal use and for my business, I could, you know, split that. But it's just important that the business is viewed separately, okay? And then the last assumption is the going concern assumption. So all that says is when we're preparing financial statements that we're going to continue operating. Our intent is to continue operating. So if we knew we were filing for bankruptcy or closing the doors next week, we probably need to disclose that when we're disclosing our financial statements, okay? So those are all just assumptions of the business that we make. So the principles, this is where we get into, especially the last two, revenue and expense principles. These really affect how we account for money and how we do our transactions within our business, okay? So principles, we have the measurement principle. It kind of goes along with the cost assumption. Basically, you know, it determines how much we record and report the value of things, okay? So we're looking at again, if I'm an investor and I say, hey, I have these 10 acres of land, I will invest them into the business. We need a value. We need to put some monetary value to that land to apply, some ownership in return for that. Okay. So we need to be able to measure, and it needs to be verifiable. So, we might need to get an appraisal of the land to get a good idea of what that land is actually worth. Okay. And then as far as how we record it, if we're purchasing something, say we purchase land, we're going to record it at the cost we paid. Okay, that's the historical cost principle, or just cost principle in general. So that means that land, we might have paid $20,000 for it. What if it's worth $25,000? The value is 25. Isn't that what I should record it as? That's what makes sense. But no, in accounting, we're going to record that land at the price we paid. Okay. Now that doesn't mean when we sell it, we're going to make a gain because it's worth more. But when we pay for something, we record the price we paid. Okay. So we always put it at its initial transaction price. And we'll get into that when we talk about land and equipment and buildings and all that fun stuff. Well, revenue is just the money we earn from providing services. Okay. So when I go mow someone's lawn and I charge them $40 and they pay me, that's revenue. Okay. Well, when we're publicly traded, what we have to follow is the revenue recognition principle. So I go and mow my neighbor's lawn, and they're home, and they pay me $40. I perform the service right then. I'm going to recognize the revenue that day. I go next door, I mow their lawn, they're not home, so I leave them an invoice. I perform the service that day. I'm still going to recognize the revenue that day, even though they didn't pay me that day. Okay. So with publicly traded corporations, we always recognize revenue when the service is provided or when the goods are exchanged. Okay. Whether they're paying me today or in 30 days or, well, hopefully within 30 days. We'll talk about that in another class. But so that's the big takeaway. That will be a principle that we'll deal with all through this class and in financial accounting. So revenue is always recognized when it's earned. Okay. When we provide the service or when we provide the goods. Okay. It's very important. Because what can happen is, the reason that's so important is, if I wanted to lower my tax obligation, I could say, oh, I'm not going to report the revenue until I get paid next year. Well, that's lowering my profit, which is lowering how much I owe in taxes, which is not accurate, is it? Because I actually earned the revenue this year. Okay, so that's kind of the purpose behind that principle. And that's where some of the scandal and problems were coming from. They were reporting revenue, or they weren't reporting revenue accurately. They might have been reporting revenue though that they hadn't even earned yet, which is another problem. So it has to be earned to report it. And on the flip side of that, our last principle is the expense or matching principle. It's the same idea. An expense is something we owe, right? We pay for. It could be rent, utilities, salaries, anything like that. We have to report expenses in the period in which they were incurred. So I go and buy supplies at Office Depot or Lowe's. I guess I mow lawns. I go to Lowe's and I buy a new lawnmower and I put it on Lowe's. I owe Lowe's later for it. I'm going to recognize it the day I buy it because it was an expense that day. It's helping me earn revenues as soon as I buy it. Okay, that's why it's called the matching principle. We recognize expenses when they're incurred because the day we buy them is when we start using those to help us earn revenue. So the revenues and expenses match up. Okay. Any questions on those two principles? Those are really the big ones. The cost principle is important too, but understanding revenue and expense recognition will help a lot. Okay, so that's all the dry, boring theory stuff. Now we get into the fun. So you probably saw, our basic accounting equation. Does anyone remember our basic accounting equation from the reading? Very good, yeah. So our basic accounting equation is assets equal liabilities plus stockholders' equity. Okay, so assets equal liabilities plus stockholders' equity. This is the basic accounting equation that we'll use in all accounting courses. Okay. So what does it mean? Well, it kind of tells us, right? It says assets, resources owned by a business. So think of assets of anything of value that the company owns. Okay, assets are anything of value that the company owns. Cash, equipment, supplies, anything like that. Buildings, land.
Clothing.
Yeah, clothing like inventory. Those are all assets. Liabilities are things we owe. They're debt. Okay. So when I look at a liability, it's a debt. It's something I owe that I'm not paying for right away. So this is usually like a mortgage or like a car loan, or just money I borrowed from the bank, or when I've purchased something on credit. So a liability is a debt and something that I owe and I'm going to pay later. Okay. And then equity, as it says, are the rights of the owners. Again, we're dealing with a corporate accounting situation. So we're looking at what we call stockholders' equity. So another way, the way I like to look at equity, it's kind of like a net worth situation. Okay, I can rewrite this equation. We usually put it in this manner, but you could rewrite it. We can use a little algebra moving around. Stockholders' equity equals assets minus liabilities. To me, that helps define what stockholders' equity is. So right to the owners. What does that mean? Well, if we take everything of value, all the assets, and we pay off all the debts, hopefully there's money left, right? That's the equity in a business. That's the worth, the value. So stockholders' equity is really like the net worth of a company. What are they worth if they took everything they owned and paid off all their debts? Okay. So when the business, say, gets liquidated, the business goes away, they're going to take all their assets and pay off all their liabilities. What's left is going to be given to the owners, the stockholders. Okay. So it kind of just helps to understand what those three components mean, and that you can rewrite the equation to calculate it. If you have two parts, you can always find the third. Okay. If I know liabilities and equity, I can add them together to get assets. If I know assets and liabilities, I can subtract to get equity. And same with liabilities. Okay. Any questions on that so far? So the big point of this accounting equation is that we have to stay in balance. Okay, it doesn't matter what we do. Every time we do a business transaction, this accounting equation has to balance. Assets should always equal liabilities plus equity. Okay. So that's when we get into the actual kind of work in the chapter. We start talking about business transactions. A business transaction is any time we exchange goods or services for money. Okay. Or any type of exchange of money or goods and services. Okay. And we can define that within our accounting equation, and it's going to stay in balance. So if I invest money in the company, that's a business transaction. I buy a lawnmower, that's a business transaction. I hire someone, that person works, and I pay them, that's a business transaction. Okay. let's see, before we actually get into transactions, we do have, let's do a quick example together because our first example is just actually working in this accounting equation. So I get into that and then we'll kind of talk about the accounting equation before we get into transactions. I'm going to go back. So if you haven't, go ahead and log into Canvas. And once you're in Canvas, you should be able to click on the Chapter 1 practice under Unit 1, Chapter 1, and that'll open in Cengage. Takes a minute. Okay. So you can hit Start Assignment now once you get there. You're in the Chapter 1 practice.
But mine's not doing it. Just show the assignments.
Click on All Assignments. And scroll down. Oh, I think it's because you clicked on the Chapter 1 introduction, maybe. I don't close that, but it's okay. Just scroll down, you'll be able to get to it. It's just, they kind of list it at the end. So,
That's at the very bottom.
yeah.
Okay, that's fine.
Okay, yeah, so just click on Zoom on that tab.
I know that.
So this one, we've, kind of just looked at the accounting equation. So I thought we'll do this one first together before we move on to transactions. So all this first little practice is again, kind of reiterating our accounting equation always must be in balance. So again, if we know two numbers, we can always find the third. So if assets equal liabilities plus equity, on part A, what would my assets for this business be? Yeah, very good. You're just going to add, right? Because you're missing assets. So I would just take my liabilities plus my equity to be able to find my total assets. Okay. So is that like 1,800,000?
895.
There you go. Thank you. 1,895,000. Okay.
We write that in there.
Yes, yeah, you can type that in. And as you can see, these aren't graded, but we can just do them together. That way you'll have some examples to help you with the homework. Oh, just click Open Course, and it'll get you right on in.
We need to put the problem.
Yes, you'll have a free 2-week trial, so then you can just say in this language. Yeah. Okay, perfect. So while we're in here, since I know a lot of you did the little adaptive learning plan, these are more similar to the homework that we'll have. So I'll point out a couple things as we go through. I heard someone say I should have had a calculator. Well, if you didn't bring a calculator, you can use your phone, or there's actually a calculator in Cengage.
Okay, I see it now.
So if I click that, it opens it up. I can drag it around wherever I want. You can actually click on it, or you can use the number keypad on your computer. So I always point that out. It's always nice to have the calculator. Yes. A couple other things. If you notice, if you move your mouse over any thing that's in green, it tells you the definition. That's kind of cool, right? I moused over accounting equation and it brought up the accounting equation. So a lot of our homework's pretty interactive and it'll help you. Let's see, another thing. If I move my mouse over, I have the ebook. Notice it tells me what learning objective it is. If I click on that, it actually opens up the ebook and the objective that this problem is over. Okay. And I won't do that on the exam, but you do have access on the homework. So then it opens up to the page, which is pretty nice. But I still have my other tab open. Again, I could mouse over, and I don't have to click anything. I just move my mouse over assets, and it gives me a definition of assets. So, you know, you're getting used to all these new terms and everything. So use the resources within Cengage. You have that, and then like there's a show me how for a lot of your exercises. That'll actually open a video. I got my sound turned down. And you can actually watch an example just like the one you're working on. Okay. So then you have the calculator. Oops, sorry. You could print it out if you wanted as well. Like, so you could have, if it's like a long problem. And then students' favorite button, or one of their favorites, the good old check my work. And here you have unlimited check my work on all your homework. Okay. Again, not on the exam, but on your homework. You can hit check your work, and it'll put a green check mark if you're correct, or a red X if you're incorrect. It won't check it if you haven't completed it yet, but if you put a number in and you think you're right, check my work, you can use that as many times as you'd like. And the other option, which is hidden by my little video thing, there's an email instructor button. If you click that when you're in a homework, and you can say, hey, I'm having troubles like calculating net income. You click that, it sends me your numbers, the problem you're working on. So when I open it up, I see exactly what you see. So it's a good way if you're working on homework at home and you have a question, email instructor. Save and exit when you're not finished. Notice when I checked my work, I got a score update. So it tells me as I go through what my score on the assignment is too. Okay, so there's some great resources within the homework. You know, really makes life a lot easier. So you'll know, you can always use check my work. So you'll know as you're doing your work if you're complete and correct or not. Okay, any questions on any of those little features? Okay, so on to the next one. Well, I didn't rewrite the equation this way, but we can calculate liabilities too.
It's 187.7.
And how did you get that?
Subtracted.
You subtracted.
Yes.
Very good. Yeah. In order to find liabilities, we would just take assets minus equity. So you can always rewrite that equation and solve for your missing part. Okay. So really the whole point of this isn't that you can, you know, subtract and add, obviously, although it's always a nice refresher. It's really to understand that that accounting equation is in balance. Okay, this is after several transactions. So we've had several business transactions, and after that, we're in balance. Okay, so now, as you said, Part B, we took 776,500 minus 588,800. So our liabilities are 187,700. Okay. So now we found liabilities. And equity, again, to find equity, assets minus liabilities.
10,295,000.
Very good. So we take our assets of 14,750,000 minus our liabilities of 4,455,000. So 10,295,000. Okay. Again, that one's very simple, right? Pretty basic. And again, we could always check our work. Now we have a 20%. Yay! We're getting somewhere, right? So this will be how your homework works too. You know, sometimes, obviously, you'll have more homework than what we go over in class, but you might have very similar problem on your homework or the exact same thing with different numbers. Okay. Okay. So I'm just going to. We probably won't. If you want to go ahead and save and exit on that chapter 1 practice, we probably won't get into more of the practice today because we have about 20 minutes left and we'll be doing transactions next and we're just not ready for that yet. So go ahead and hit save and exit on that. And we're going to talk more about this accounting equation and the transactions. Because really, the last of the chapter is all dealing with being able to recognize business transactions and how they affect this accounting equation. Okay, So I'm going to go back to my basic accounting equation here. Okay. So again, anytime we have a business transaction, it's affecting at least two accounts, what we call accounts. They don't actually talk about accounts in this first chapter, but I think it's better to go ahead and talk about them. So we have different types of accounts, like a cash account, okay, equipment, supplies, all of that, revenues, expenses. So under each of these different main categories, our accounting equation, we have different accounts. So for example, under assets, some common assets would be cash. Okay, cash, money we're receiving, obviously, money coming in. We can have accounts receivable. Accounts receivable. That's when customers owe us money. Okay, so I've mowed a lawn and I billed my neighbor, so they owe me money. Okay, accounts receivable is money owed to us. We can have supplies. Okay, like I bought checks and I bought pencils and papers, a computer, you know, all of that. Well, a computer's really more equipment, but basic supplies. We can have equipment. So equipment would be like my lawnmower or my computer, that sort of thing. If I actually had an office that I rented out, you know, it could be like land that I owned or buildings.
What about uniforms or like shoes and stuff like that? Would those be considered too? Because you have to have certain types of shoes to wear when you're mowing your yards. So
Yeah, I like classify those as like supplies.
supplies,
Mm-hmm.
okay.
Or expenses. It might just be like a clothing expense, honestly. Yeah. Okay, so assets, anything we own of value in the company. So those are some basic accounts. Okay, there's more, but those are the main ones we're going to start dealing with. Liability, again, is something we owe. The only liability we're going to deal with right now is called accounts payable. And that's when I buy something on credit, so I owe. So I have to pay it. Okay, so accounts payable is when I owe for something. So if I buy supplies on account, I don't pay cash, and then it's going to affect accounts payable. And the PowerPoint kind of goes through and defines these as we go, but I think it's kind of better to set it up from the beginning too. So stockholders' equity is a little bit unique. You know, these are all asset accounts. This is our one liability account for now. Stockholders' equity has different types of accounts. And we have revenues. I'm putting a plus by revenues because revenues increase equity. Okay, that'll make sense as we go on through this. Revenue, well, what is revenue?
Money earned for doing some sort of transaction.
Very good. Yeah, the money we receive, right? Or that we earn. We may not receive it yet. The money we earn, I said receive, for providing goods or services. Okay, so very good. Revenue is the money we're earning. A lot of times, I'm going to put this in parentheses just because it gets confusing. The account that they'll talk about is fees earned. So fees earned is a revenue account. Okay, so we're talking about revenues in general. There can be different types of revenue, like rent revenue or ticket revenue, stuff like that. But in this chapter, a lot of times they call the revenue account fees earned, and that gets a little confusing because we hear fees and we think we owe, but it's money owed that we've earned, so fees earned. And then our other increase to equity is common stock. What is common stock?
Portion of the company or shares of the company that's sold through a trading like the NASDAQ.
Yeah. Yeah, very good. It's ownership of the company, right? Common stock is when, yeah, we have investors that buy stock of our company. Okay. So common stock increases equity. That's those shares that we're selling. Okay. And then we have two types of accounts that decrease equity. We have expenses. When you think of the word expenses, what do you think of, like, for running a business? What might be some everyday expenses that we would have to pay? Do what? Gas, good.
I will say payroll.
Utilities,
Payroll.
payroll, perfect. Those are some big ones, right? So yeah, we're gonna have a different expense account for every, you know, like it could be utilities expense, telephone expense, wages expense, all of that. So I'm just gonna put some in parentheses as example. It could be rent, utilities, wages. Those are some of the big three, right? Anything, an expense is anything we pay as soon as the bill comes in, you know, so it's just an everyday cost of running our business. So we're paying the rent, we're paying wages, utilities.
Food costs.
If that's part of our company, yes, then that would be under there. So those are just some expense, you know, examples that we'll see. And then our last one that reduces equity is dividends. Okay. Does anyone know what dividends are?
It's a percentage of the price per share that the company gives you as a handout for purchasing their stock and holding it.
Good. Yeah. Dividends are money paid to the shareholders or stockholders. They're a part of the profit. So when we have a profitable year and we have cash to pay it, we can reward our shareholders. Yeah, it's like a bonus to the stockholders. So we're giving cash or stock to the stockholders. So it's just payouts to our investors, to our stockholders. Okay. Companies aren't required to pay dividends, and not all companies do. But when we're a newer company, it kind of helps to start, you know, giving investors incentive to stay as investors when we're sharing some of our profit. That's what we're doing. We're taking some of our company's profit and sharing it with all the owners or the stakeholders in the company. Okay, so it can keep stakeholders happy. It can also give them a sense that, you know, we're going to continue to grow and that we're doing well, because you don't pay dividends when you're, you know, when your company's going down the toilet usually. Because you have to have a profit and you have to have cash. You can't pay dividends. You know, your board of directors is not going to approve a dividend payout unless you can support it. So again, it depends on the company. Some companies never pay dividends and some do regularly. So there's no hard and fast rule. So these are kind of, I guess I shouldn't put that in front of them. Those aren't negatives necessarily. Those are just the types, okay? So when I'm looking at a transaction, what I need to look at is every transaction is affecting at least 2 accounts. And again, there's a long list of accounts. You know, depending on how big our company is, it's going to grow. But we're going to look at service companies, which theirs are shorter. So we have all these accounts, and every time we do something, it's affecting at least 2 of these. So it's affecting our accounting equation overall. So when we start analyzing business transactions, which we'll do in this chapter and then again in chapter 2, we'll really do it all the way through accounting, but in those first 2 chapters is when we're really learning and building. You always have to remember some basic things. It has to affect at least 2 accounts, right? If someone gives us money and we say, oh, we got cash increased, yay. But what did you get the cash for? You have to show that, right? If an auditor comes in and is like, oh, I see you got $500, where'd that come from? And we're like, I don't know. That's a problem, right? So we have to be able to say and show. That's the whole point of analyzing transactions, is to keep records. So we're keeping record of every time we do something, what is happening. So what did I get cash for? Well, I mowed a lawn. I mowed a lot of lawns for $500, or maybe it was a really big lawn, right? Or maybe I really overcharged. I don't know. It might take me a long time since I don't know how to do it. No, I have mowed lawns. I'm allergic to grass, though. That's my, like y'all care, right? You're like, we don't care if you mow lawns. Anyway, so that $500 is revenue. I earn money for providing services. So I'm affecting cash. Cash is increasing in my business, and revenues are increasing in my business. So my assets are 500 and my equity is 500. So they equal. That's what we do with every business transaction. We look at, well, how is it affecting my accounting equation? What is it affecting? Is it increasing assets or decreasing assets? So these are questions we ask ourselves. So every transaction is going to affect at least 2 accounts. It can affect more. That'll be fun. It can be, but it has to keep the accounting equation. The accounting equation must stay in balance. Okay. So we have like 10 minutes. So, right? Yeah. It's like, yeah, it's a 2 to 3:15. I have to remember that. So we'll start doing just a couple together, and just so we can kind of start looking at them. And then Wednesday we'll pick up where we left off and kind of go through more transactions, and then we'll practice some together on that chapter 1 practice. Okay. So it gives us a transaction. On November 1st, Chris Clark deposited $25,000 in a bank account in the name of Net Solutions in exchange for shares of common stock. Okay. Well, we talked about common stock ownership of the company. So he's saying, I'll give you $25,000 and I want $25,000 worth of stock. How's that affecting our business? Well, cash is being put in. Cash is increasing. Cash is an asset. So cash assets are increasing 25,000. Well, he wants common stock. That's increasing the ownership or the equity in my company by 25,000. So common stock and equity are increasing. So in this case, we're only affecting assets and equity, and they equal. So you could put the liabilities as 0, and our accounting equation is in balance. Okay. On November 5th, we paid $20,000 for the purchase of land. Well, this one's kind of fun because you see, it only affects the assets. But we have one asset increasing and one asset decreasing. Okay. So cash, we paid $20,000, so cash is decreasing. We had $25,000 in cash from common stock. We bought $20,000 in land. So I subtract $20,000 from cash, but land is also an asset. We now have $20,000 of land. So land is increasing. So it can just be that we have this transaction only affects assets. One asset is increasing and one is decreasing. So our total assets are still 25,000. So our accounting equation is still in balance. Okay. So we can have transactions that only affect one side of the accounting equation, but the overall accounting equation has to stay in balance. Okay, so if you're only on one side, you better have one increasing and one decreasing, right? Our first example, we had 2 increases, but they were on opposite sides, so we stayed in balance. Any questions on those 2 transactions? On November 10th, we purchased supplies, and it says we agreed to pay the supplier in the near future. So we didn't pay cash. We bought supplies. Well, supplies is an asset, and supplies are increasing. So supplies goes up. Cash and land stay the same. And then on our right-hand side, nothing happened to like common stock or equity. But we now owe. We've created a debt, a liability of $1,350. So accounts payable, which is a liability, increases. Our debt increased. Okay. So supplies increased and liabilities increased. So we'll take a minute and talk about supplies and then we'll stop for the day. So supplies are kind of a fun one. Notice they call them a prepaid expense. Okay. So this is where it gets a little tricky. Supplies are an asset. We purchase them to help us earn revenues in our business. Like I have supplies in my hand, right? What happens? Is this going to last me forever? No, I wish, right? I wish they had forever, like unstoppable, everlasting. So when I consume this, when I use this up, I need to expense it out. So that's why we call supplies prepaid expenses. We're paying up front, and when we have them and when we hold them, they're assets. Because I could technically, if I hadn't used this at all, I could take it back and get my money back for it, right? It has value. But as I use it up, I need to expense it out. So when we first purchase supplies, we're going to increase the supplies account asset. Supplies is an asset. At the end of the month, we're going to look at, well, how many supplies did we actually use up? And we're going to expense that, okay? So we'll do that in a later transaction, but it's just good to kind of understand that supplies are what we call a prepaid expense. So while we have them and we haven't consumed them, they're an asset, they have value. Once we use them up, we need to expense them out. And we'll learn how to do that on Wednesday. Any questions so far? I know it's still covered a lot of material. Yes, are you good? Okay, you're like, you're good, okay. Like, question, no. All right, so again, Wednesday, we will just pick up where we left off. We'll go through more transactions. But Wednesday, we'll spend a lot more time doing examples in class too, okay? So have a great day. Enjoy the nice weather before the weather drops again, right?
Tomorrow.
I give it 3 hours.
Right.
Tomorrow we gotta go.